Hi, my name is Jefferson Calloway. Today we'll be talking about real estate, all the different strategies you can use to acquire real estate, creative strategies for acquiring real estate, subject to seller finance, assumptions, and Morby methods.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Get ready for the Midwest Real Estate Investor Conference in Grand Rapids, Michigan. Join hundreds of real estate investors for networking, learning, and growth. Be sure to mark your calendars for April 24th and 25th of 2025. Hello and welcome to episode 488. Scaling a real estate portfolio is challenging enough, but doing it across multiple states while serving in the military takes a whole different level of strategy. Jefferson Calloway started investing in 2019 while stationed as a helicopter pilot in the U.S. Army, buying a townhome near Fort Rucker, Alabama. Since then, he's mastered creative financing and grown his portfolio to 27 doors across 7 states with over $1 million in equity. Today, Jefferson is here to share how new investors can find and finance deals creatively, scale in high-interest markets, and why investing near military bases might be one of the best-kept secrets in real estate. Jefferson, welcome to the show.
Thank you very much, Brian. I appreciate it.
First of all, let's start with you being in the military and beginning your investing career at the same time. Thank you for your service to our country. I always love having military veterans on the show because I think you guys bring a very specific perspective to real estate investing. And I always love having that conversation. But fill us in on your background and just how you did get started investing.
Well, first of all, thanks for the support. We always very much appreciate that. The background is pretty much just as you described. When I was stationed at Fort Rucker, the real estate market there, really the entire state for the most part, is very cheap. And it was great, actually, as it turns out, for a beginner investor, which I was. I had no property when I first went into the Army. And so some of these single family townhomes, this was one of the few areas now in America where the purchase price to rent ratio really makes sense. And so I purchased a townhome. I think the mortgage at the time, because remember this was 2019, interest rates were 3% back then. I think the mortgage on that property, including interest, tax, and insurance, was $450, and we could rent that thing out for over $1,000. So I did what I preach is one of the best strategies for beginner: house hacked, lived in it, and then as soon as I was stationed someplace else, started renting that one out, and then bought another one, and then so on and so on. And that's such a great strategy for snowballing as a beginner. But the military base was such a great place to start, not only for that reason, but also because when you're near a base, soldiers are cycling in and out all the time. And they can't act too much of a fool in your rental units because you'll get in trouble at work with your chain of command if you get in any legal trouble or rental trouble even in your off hours time. So it's really a great place and a good strategy for getting started, or even once you have started.
So as far as financing, as you were going along, were you leveraging VA financing, or were you using something even more creative?
Yeah, at first, the VA is the obvious choice. Anybody who has served obviously earned their benefits, but they're some of the best benefits. I mean, you have just the funding fee, and even that can be waived. So one of my VA transactions, I actually came to the closing table with 14 cents. I mean, you can't beat that, especially if you're finding the deals right. And that's up to multifamily, up to 4 units. So you can really, really use some powerful house hacking with a VA loan. The thing is, you do, if you keep buying something, living in it, later moving or getting stationed someplace else and renting it out, you do have a limit to how many you can have at one time. So I have since moved into some FHAs, some conventionals, which I believe are better. No PMI can fall off automatically. They all have their own little nuances, but like a lot of people from my hometown, which is rural in Maryland, use USDAs. That's also 100% LTV funding. So VA is the best tool in my opinion, but they're all pretty sweet for house hacking. banking in general.
You just mentioned two things I want to follow up on: PMI and did you say USDA funding?
Yeah.
Explain what both of those are to our audience.
So the United States Department of Agriculture places government backs loans that are in rural areas with zero down. I mean, you literally come with, I think there might be a small fee similar to what there is with VA, but in general, it's not like a conventional where you have to bring 5% down. On the American average right now, a $400,000 loan, you're looking at 20 grand just for the down payment, not including closing costs. So zero down is a big, big deal. And VA and the USDA are the only ones that have that. But if you have to pick between some of the ones that you might not qualify for, like if you can't use VA and you can't use USDA, you're not a rural area, you're not a veteran, that pretty much leaves you with government-backed options of conventional 5% down or FHA 3.5% down. And with FHA, a lot of people might not know, your PMI, this extra potentially few $100s a month, doesn't fall off automatically, and it never comes off even once you breach the 20% equity mark. You have to refinance out of that loan. So I think for most beginners, it is worth it to put an extra 1.5% down, go with conventional. And then as soon as you reach that 20% equity mark, you can call the bank, get a reappraisal, and then get your PMI taken off automatically.
And PMI is what, private mortgage insurance?
Yeah, private mortgage insurance. And it's basically just, for anybody that doesn't know, the bank's protection from their insurance policy for a default in the case that you haven't already breached that 20% equity when they foreclose. So that's just to protect the bank, and it usually doesn't equal more than a couple $100. But once you get $300,000, $400,000, $500,000 home loans, yeah, that can make a big deal. It can be the difference between cash flowing and not cash flowing in an investment property.
Talk about your snowball effect. I mean, you started investing in some of these properties while you were in the military. How did that keep going, and how did that keep growing?
The house hack is, in my opinion, the bedrock, and I think that should be the case for pretty much every new investor, because it is. What are the two things that most people are afraid of in the beginning? Picking the wrong property or not having the capital, the liquid cash to invest in real estate. Well, you kind of take away both of those. The first one, you have to live somewhere. You're either going to rent or you're going to buy. So pick something multifamily or at least single family that you can rent bedrooms out, something to offset what is America's biggest chunk of your income, 30 to 50% most of the time, where you live. So you have to live somewhere. So pick a property that has something else that you can rent out about it, and then house hack. The second thing is the capital. It's low money down. And so when you do that, you're pretty much bypassing the two. If you don't live in the property, let's just get down to brass tacks. If you don't live in it for at least a year, you're going to have to come with a bare bones minimum of 15, most of the time 20 to 25% down. Even on a $100,000 property, that's 30 grand. So it's really the best way to do it. And I think what holds most people back is if you've got a wife, if you've got kids, if you've got somebody in your household that's not on board with living around other people or renting stuff out, or they're not comfortable with it, that's a hurdle. But, one of the best presentations I ever saw was David Green at BPCon once put a spectrum on the board: comfort and wealth. Where do you want to be on that spectrum? If you want to be super duper comfortable, you're probably not going to be wealthy nearly as fast. But if you can give up just a little bit of comfort, you can get to wealth much, much, much faster. It's the truth.
You made a point that I really want to just drive home with our listeners. And that is, if you're buying a rental property and you're not going to live in it, you're going to have to put down 20, 25%. But if you do live in it, there are options, and I want you to just kind of tell what they are, where you only have to come in with what, 5, 10%?
Back that up. You said if you do or don't live in it.
No, if you do live in the property, there are options where you can come in with just 5% down or less.
Or zero. Yeah. 0, 3.5, 5, or anything, anything above that. But yeah, the point is, the best terms I've ever seen are, for the most part, 15% down. That's just a single family. And that's with a, 760 plus credit score. So most of the time, yeah, you're putting 20 to 25% down.
What are the specific products where you can come in with 5% or less down? Is it FHA?
Conventional, USDA, and VA. Those are the 4 that I'm aware of. There is one, if you can find a local credit union, there's one in Alabama I found called Ally. There's a couple of credit unions that under very, very rare and specific circumstances can do 5% down on a rental property. But you better have a powerful credit profile. And I think it's got to be single family. And there's a few other criteria. But for the most part, those 4 products are pretty much it.
For listeners to the show who are trying to figure out how to get their first property, what you're sharing right there is gold, because it's house hacking. And I've said that many times, had many guests who we all agree house hacking is the best way to get started. And if you can get in with a low down, 5% or less type of loan, you can really pencil out nicely. So thank you for sharing that. So again, let's keep going with the snowball. What did we say in the intro, 27 doors you've built up to, or is that old information at this point?
No, it's accurate. We're under contract right now currently for 11 more units. So that's soon to be, in the 30s going on 40s. But for now, that's what we've closed on. And really the most important thing remains, I can say, even once you've gotten a little more seasoned, is liquid capital. It is just so valuable. That is what determines the velocity of how fast you can build your portfolio, how fast you can replace your active income. And that never goes away. That's the way it always stays. That's why I say best case scenario, if you can, house hack every single year. The legal amount, the legal limit is 1 year. You must live in the property for 1 year, and I wouldn't fool around with it. But on top of that, if you want to move faster than one property per year, that's when creative finance comes into play. That's when wholesalers come into play. There are other ways to still be very low money out of pocket. And Morby methods, seller finance, subject twos are, I think, the second best method for acquiring real estate, because all the other ones require traditional financing, which right now means crap terms, 7-8% interest rates. You're going to put a whole bunch down. It's going to hurt. So creative finance would be my next best tool for advancing fast.
You just mentioned a lot of different creative financing techniques. Tell us how you've applied some of those to what you've actually done and been able to acquire.
So subject to, and a lot of these terms have been around forever, just coined by Pace Morby. So I'll always give credit, where it belongs. But what he always preaches, and what I have found to be the truth, is those are the deals where the lowest amount out of pocket and also the best terms are going to be found. I mean, I've probably at this point closed, and just in the last year or two, 5 subject to deals, and almost all of them were either 2 or 3% interest. And that's in today's market, today's climate. So those mortgages, like I've got an Airbnb down in Virginia right now that's worth $350,000 now. When we bought it 2 years ago, it was $220,000. Bought it subject to. That interest rate is 2.2%. We pay in the seller's name, put it in a trust, and now that mortgage is $1,000. But on Airbnb, it brings in $5,000 a month in revenue. So it's really powerful stuff. And in today's climate, that would be easily a $3,000 mortgage payment. It wouldn't cash flow. So you combine subject to with some seller finance. We do those a lot too, and those are better. I just negotiated one of those at 4.25%. And you can also negotiate directly with the seller about your down payment. Good luck doing that with a bank. So they're just really powerful tools. And there's a lot of different ones. You can combine them. Like the Morby method is one of my favorite ones. That's what I'm under contract for right now. You go and get a bank loan for 75% LTV. Normally means you have to put down that 25% down payment. Well, what if you talk to the seller and get them to just bring, instead of the whole amount on seller finance, just that 25%? They're much more likely to say yes, and that covers your entire purchase price. 0 out of pocket for the investor. I can't imagine a better deal than that.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Save the date for the Midwest Real Estate Investor Conference happening April 24th and 25th of 2025 in Grand Rapids, Michigan. This event is the perfect place to connect with fellow real estate investors, gain valuable insights, and elevate your real estate game. With a lineup of expert speakers and numerous networking opportunities, you won't want to miss it. What's your system to find these types of deals where you are communicating directly with the seller and you don't have a broker or realtor in between, poo-pooing what you're trying to accomplish?
The broker and the realtor in the off-market world is the wholesaler. And I'm telling you, they are God's gift, I tell you, to a real estate investor, because they do all the stuff that I either don't want to do, don't have the resources to do, or don't have the time to do. Like, I work full-time running a home remodeling company up here in Philadelphia. I do not have the time to mail sellers and have a conversation with 20 different sellers, one of which are serious. No, a wholesaler will just get a deal, do all the legwork, and then just post in Facebook, hey, got this subject to deal. Here are the terms. Let me know if you want to go under contract. They do all the heavy lifting. So wholesalers are amazing for that reason. You just pay them their little fee. They usually don't ask for much. And then you get all of the communication with the seller handled yourself. The deal's already been negotiated. They're already under contract. You really can't beat it.
I'd like to talk a little bit about you working directly with wholesalers and finding deals through them. I think there's a special relationship there where on your part, you want to find wholesalers who can deliver and aren't just reselling someone else's deal. On their part, they want to make sure that they're dealing with buyers who will actually perform and execute. So can you talk a little bit about that and just how you find wholesalers who have good deals and, beyond just finding them on Facebook, and how you work with them so that they know that you're someone they can trust?
I would say the first thing is they're looking for serious buyers. So be a serious buyer. My best advice would be, don't go on Facebook messaging people unless you have liquid capital, you somewhat know what you're doing, and you are ready to buy. You'll be seen as a tire kicker if you act like one. So one of the reasons why so many wholesalers are putting deals in my inbox and my text message inbox every single day is because they know I'm a buyer. I buy. If it's a good deal and they know they send it to me first and it's a good deal, it's going to get purchased right away. So be a serious buyer and you'll be seen as a serious buyer. As far as who they work with or if they're recycling deals, I always see that as it's really none of my business. My number one and only concern is this a good deal given the circumstances? And if it is, I actually don't care too much who else is involved. I'm under contract for 5 units right now in Little Rock, Arkansas. And the wholesaler is in cahoots with a listing agent who's in cahoots with the seller. So there's 3 people involved in this transaction that aren't me. And guess what? I don't care. I talk to one person, the wholesaler. He does all the communication with the other 2. And all the terms have already been placed up front. I know what the seller's commission is, the listing agent's commission is. All of it's getting paid, and it's a good deal. So I don't care how many other people are getting paid, what they're getting paid, none of my business. It's a good deal for me. If they're making great money on it, great. I hope they do.
Let's talk about the 11 units that you're under contract for, which by the time this episode comes out, you'll probably have closed on them. I would hope.
I hope so.
Just walk us through that one. Like, how did it fit into your parameters? Because it's going to increase your portfolio by over 33%. So how did you find it? How does it fit into your system and your parameters? And how do you plan to execute on it to add value?
So it's actually 3 different deals that make up this 11 units. I was looking for a primary residence. I was living in Middle Delaware, and my spouse and I were looking to move up north more towards Philadelphia, so I didn't have such a big commute every day. So while looking in the area, we were, wouldn't you know it, looking to house hack. So we found in Collegeville, which is Montgomery County, Pennsylvania, one of the richest counties in the whole state, a multifamily, which is hard to do, but we looked around a lot and we have a lot of agents looking for us. And so we found a 3-unit. We're under contract to close on that, and it's going to cash flow beautifully almost while we're still living there. So that was a great deal, and that's 3 units. The other 3, while I was looking a few months ago, one of the realtors, and this is a great tribute to why you should always be working with other people, wholesalers, agents, another agent who was just at a normal listing appointment for a primary single unit home said, hey, I've got a weird deal out in Western PA. It's a seller finance and VA loan assumption, not subject to assumption deal, a combination. So $600,000 purchase price, 300 seller finance, 300 remaining on the VA loan. I'm going to assume the loan. Already talked to the bank about it. They're fine with it. Seller finance the other half, and it's 3 really, really big units on 3 acres. Beautiful property. Went and saw it the other day in Western PA, Abbottstown. So that one we're under contract for, and it's going very well. And then the 5 units in Arkansas make up the last of those 11 units. So it's really 3 different deals. And the funny part is, 2 out of those 3 are all creative finance. One's nothing out of pocket, one's $50,000 out of pocket, and then the other, we haven't calculated that yet, but I'm going for 0 out of pocket on that one as well.
What are some of the other creative financing techniques that you've used?
The main 3 are subject to seller finance, and then the 2 that are not, well, those are 2. The third one would be the Morby method, which is the one where you go and get a bank loan for, let's say, 70% LTV, but you have the seller finance you the last 30%. So you have a total of 100. You come into those deals with nothing, which is awesome. I would say the fourth, and really the other unsung hero of creative finance, is the assumption. That's the one most people don't talk about. And that may be because one of the big advantages of subject to is that you don't have to qualify for a loan. And you're, not having to pull a bunch of docs and get your credit pulled. That stuff's a pain. But with assumptions, it's kind of nice because you don't have to do any fancy footwork. You don't have to deceive the bank. You don't have to do any of that stuff. You're qualifying for the loan, but you still get the interest rate. This interest rate right now is 2.4%, something like that. And I'm going to qualify for it legally. It's a VA loan. It's an amazing, amazing loan. And I would say the most powerful part that people sometimes forget about with assumptions and subject twos are the amortization schedule. Most people, if you ever look at an amortization schedule, see the interest is front loaded. And the bank counts on that. The average American moves every 8 years. So most people spend all the first 8 years paying almost all interest, move, get a new loan, and start it all over again. And the bank knows that, and they love it. With a subject to or an assumption, usually the loan, by the time you get a hold of it, is already at least a few years old, sometimes 5, sometimes 8. Where I've got one right now, my wife and I closed on the year before last, that was 20 years into the loan. Those payments are almost all principal. So a loan that's already got time in is very, very valuable. It's just another wealth building reason why you should be into creative finance no matter who you are.
Great point. I mean, that's something people don't think about even when they refinance, that they're restarting that whole amortization schedule where they're front loaded with all the interest payments and very little of their monthly payment is actually going to principal.
So true.
The idea of assumption, I mean, this is something that I don't think a lot of people really think about is, can you assume the existing loan? And my understanding, and I hadn't really thought of this in terms of the VA loan, but my understanding is that most banks don't allow for assumption on single family residential or any, in residential type loans. Could be 1 to 4 units. And that's the reason why, like, they want someone to restart that cycle. And they also want to jump you up to the higher interest rate. Is there something special and unique about the VA loans that they allow it? And especially in your case, where you're a military veteran?
The answer to that for me is I don't know. The assumption is actually I'm actually the least familiar with that strategy because it's so seldom. I mean, most people, and I think that's mostly ignorance. Most people don't know it's a thing. I didn't know it was a thing till 2 years ago. And I think subject to is so popular now, everybody's aware of it, whereas assumptions are just not as popular. And I guess there's also the drawback that you do still have to qualify for a loan. But ultimately, I don't know, because I'll tell you right now, on this particular deal, they have given me zero pushback. They have no problem with it. They welcome me with open arms. They're helping me fill out the application, and it's very low interest. I mean, they could, you're exactly right, write me a brand new loan for 7-8% and be fine. But this one's at 2%. They don't care. I really don't know. I think it would probably be, my best guess is it's lender specific. Some of these bigger lenders might be saying, hey, no assumptions right now. And maybe some of the smaller ones that don't know how big of a dent it could be making in their business, allow them. I can tell you one thing, though, and that is that it's getting very popular. When you do an assumption, you have an interview or an assumption call. And that's just to basically for the lender to qualify you upfront, like a pre-qual kind of. They just call and say, hey, where's the funds coming from? Do you have them? Basically to see if they're even, it's worth wasting their time on. And when I was making my appointment, they were scheduling out weeks because they had so many assumption calls to do. It took me 2 weeks to get mine. So, and that's because of the volume. A lot of people are learning about assumptions. And in this climate, this interest climate, holy crap, I believe it. Once they learn about it, I'll bet you they're getting a lot of calls about it.
Just to make sure our audience is tracking on it when we talk about assumptions, it's basically you are stepping into the shoes of the current owner on the loan with the bank's participation and approval, which is different from a subject to where you're trying to not let the bank know that the property has actually been transferred, because if they knew that, then it would trigger a whole loan reevaluation. Probably you'd have to refinance and put it in your name.
Really glad you brought that up, because I even amongst investors in the investing community that's seasoned, there's still a lot of confusion about the difference. And I think one of the things people miss a lot is the difference between title, ownership, deed, and the loan, the financing. And you're going to be the owner, you're going to be on title, on deed in all of these scenarios. It's just about, is your name on the loan or not? And so I'm glad you brought that up, because I'll bet you a lot of people might mix those two up. Assumption, you are qualifying for the loan, you will be on the loan. Subject to, if you default on that, it only affects the person who's still on the loan, the seller.
Do you know if you have to be a veteran to be able to assume a VA loan?
I don't know for sure, but I'm pretty positive. They asked for my entitlement, and I still, because I've only used them a couple times, but basically I think you get a certain amount of entitlements that represent how many different times you can use the VA loan. And the seller is an older guy. He's not going to be using it anymore. So he left his for me. And that's the only reason I was able to do this, because I've run out of them a long time ago. But I don't know for sure, but I'm pretty sure you do. I don't know that they would let you qualify for one if you weren't a vet.
Talk just a little bit about investing near military bases. Is that part of your system as well? I mean, do you need to be near military bases, or is it just icing on the cake if you can do so?
I think it is a good strategy for a lot of the same reasons why students are a good strategy. You know, one of the things that can really ruin appreciation is population dropping or not enough demand for rentals, that kind of thing. And near schools and military bases, same principle, you're always going to have demand. No matter what, you're always going to have demand. So that's number one. Number two is you don't have to worry as much about people ruining. That's one of the biggest deterrents and detractors I see when people getting into real estate. What if they trash my place? Well, that's less likely to happen with soldiers, because their chain of command will find out and be upset with them about it and reprimand them for it. So military bases are, I think, a good place to start for that. And then I guess the most important reason, sort of just coincidental, is that military bases are usually placed in these sort of areas where real estate is affordable. I don't know why that is. I would like to learn the history of military bases and why they're placed in kind of weird rural areas like that. But Enterprise, Alabama, Fort Sill, a lot of these places, Hood, Missouri, they're in places that are pretty cheap, but still rent for a lot because of the demand. So they just happen to be in areas where the rent to purchase price ratio still makes sense right now. I know in America, those places are, because of what prices are doing, they're rapidly diminishing. But near military bases, for that third reason, I think it's a good idea.
Tell our listeners how they can find out more about you or get a hold of you.
Honestly, the easiest thing is I'm on social media a lot. You'll see a lot of my other podcasts and a lot of my promotion on Instagram, Facebook. If you just search Jefferson Calloway, I should pop right up. And a lot of people have been hitting me up on, Facebook Messenger, Instagram. But you can always try my email too. I answer those really fast within a day. I'm always in my email, and that's jefferson@calcapital.us, calcapital.us. And either one of those, I'll get the message within a day and always respond.
What is your favorite hack or app?
I guess one of my favorites right now, because you shift through them as you go through life, you learn new stuff and you try new stuff. I heard somebody say recently, and I've really adopted this the last couple of years. She said, what if you just, every decision you make, you just say to yourself, how funny would it be if I did that? As if it was like a joke, or as if you're just like, it's something that would really change your life, but you might not be bold enough to do it. And then you just do that thing. And I'm like, what if I went and started buying remote properties and just like assembled this big ass portfolio and replaced my ink? How awesome would that be? And then you just do that thing. And I have found, truthfully, this is one of the bigger things, that fortune really does favor the bold. When you just get out there and take risk. I heard Alex Hormozy say recently that Risk is just what opportunity looks like at the time. It's opportunity in hindsight, but at the time it looks like risk. So just be bold and get out there and just start making moves. If you fail, you fail. I've made a ton of dumb deals, but in real estate, it's so forgiving. You end up fine and you learn a lot.
Thanks for coming on the show today and talking about starting, in the military, investing, the house hacking, the creative financing techniques that you've shared. I mean, some of which I don't think we've really talked about too much on the show, or it's just been a long time, and assumptions definitely is something that, I can't remember talking about. So I really appreciate having this conversation with you. Thanks so much.
Yeah, I really appreciate it too, Brian. I had a good time. Thanks.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. And remember to save the date for the Midwest Real Estate Investor Conference on April 24th and 25th of 2025 in Grand Rapids, Michigan. It's going to be an event you won't want to miss, packed with invaluable sessions and opportunities to connect with like-minded investors. Keep listening for more updates, and we look forward to seeing you there. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.